went through private equity and the different range of private equity. Again, private equity is investments in companies that aren't yet public. They can be venture capital, distressed buyouts, the like. We have real estate, which can be hard real estate, but also real estate and home builders, mortgage-backed securities and the like, a lot of publicly traded and privately traded real estate investments. Commodities, we investigated the various metals, commodities like this oil, why you may want to add those to a portfolio. And then we left off at infrastructure. So I'll finish off infrastructure before I move into options. And just in terms of options to kind of prepare you where that may fit, I had reviewed the subcategories of hedge funds. And if you recall, there's long short funds. Options can be long or short. Market neutral funds, we can talk about decreasing the delta to make a trade market neutral. Global macro. Options are traded across the globe, and we'll take a look at the World Volatility Monitor. And time permitting, we'll go through an exercise that I do in my options meetup group where Warren Buffett famously croons, be fearful where others are greedy, greedy where others are fearful. You know what Warren Buffett doesn't tell you? How to measure fear and greed. And we'll learn today how we do that in the options world. And then the other subcategory of hedge funds are event-driven hedge funds, and very popular with options pricing. And we'll investigate the put right specifically, and we also hit the fifth category of fund of funds. We reviewed some macro funds, but we left off at infrastructure. And just to kind of button this up, infrastructure are usually long-term capital-intensive investments. If anybody's studying for the CFA, and again, if you want to manage money, I recommend the CFA exams. It's 3 grueling years, or I should say, I will make note of it. I will not recommend it to anybody because I know so many CFA widows that went through divorces over the minimum 3 years testing. So I don't want to get sucker punched by somebody's ex one day. So again, Jonathan Masse never told you to take the CFA, but if you want to manage money, it's a very appealing feature of your resume to get that far. But again, the CFA curriculum, hedge funds, private equity, real estate, commodities, and infrastructure. Infrastructure has been very popular, especially with Australia, where the government backs a lot of these projects and helps fund their superannuation funds, which is like their corporate pension system. So very in vogue in Australia, and certainly sparking investment across the world. Because if you recall from the first class on Tuesday, why are investors looking at alternatives? Because with equity markets at all-time highs and bond markets at all-time highs, because interest rates are at all-time lows, investors need. Can somebody type what they need? Just a recollection that they are. The class is title alternative. Let me see, chat window. Who gets my prize? Jacob Narama, 100% correct. Leon, he doesn't have to take the 5 multiple choice question. Yes, they need alternatives. And again, infrastructure is a big part of this. And what's nice about infrastructure is they generate consistent cash flows. And just in terms of the subcategories, we have they can be transportation based or utility based. Social infrastructure, those are the economic ones. Social infrastructure can be directed towards human activity, like schools, prisons, and the like. And you'll often hear about different venture schools, which are going from public to private schooling, and people can invest in these. And there are different stages of greenfield versus brownfield. Brownfield being established, whereas a greenfield or a new infrastructure project or a new bridge to be built may be a bit more risky. And different geographics will have an investment feature as well. Example, like if you invested in a bridge toll and all of a sudden we're in the shelter at home environment, you're probably not getting the cash flows you got a year ago, back when Bay Area traffic was in gridlock and everybody was using those bridges. So again, different unique risks, different unique forms, different promotions of history. When we the history of the freeway was it was a huge infrastructure investment by FDR way back in the day. When we got into our financial crisis jam, Barack Obama had a huge infrastructure spending. And Trump, during his election, for better or for worse, he was promising more infrastructure investment. So I think it would be very wise to be very in tune, especially as a finance student, to at least be aware that more and more investors are tilting towards infrastructure. And again, just in review, these investments are very unique in the fact that rather than normal distribution of returns, which is kurtosis and fat tails, fat event risk, there's even more non-normal distribution in the role of alternatives. Again, there's limited transparency and liquidity. Some of these products have long lockups that decades or determine decades of investment, especially for venture capital and private equity. Some funds, it's not uncommon to use leverage and derivatives, which isn't too common in mutual fund landscape. And because they're new, because they're alternative, you have to do a much deeper due diligence form of analysis.
Hey, Jonathan, this is Michael. Let me just let people know that they can adjust the size of the presentation. If you go to the side, the right-hand side of the presentation, and pull it all the way out, and it'll make the picture of Jonathan smaller, but you'll be able to see the presentation.
Thank
you.
And so usually at the end of my CFA alternatives class, I say, this was 2.5 hours well spent. Another passion product of mine is options. And because options are usually part of the derivative sections of the CFA exam, and again, the CFA exam is brutal. It's like taking your accounting, fixed income, equity valuation, derivatives, alternatives, 18 study sessions. It's like one final and one exam that's only offered once a year. So if you fail it, and statistics say you will fail it because the pass rate of level 1, I think, is 36%. So the math's not really in your favor. It is a very intense day at exam day. So you want to offer, who here would like to, just to recap what we studied of your program. Not to oversimplify the 300+ hours CFA candidates study for, but over the long run, what the CFA is about is money and sleep. Money in the form of higher expected returns at the expense of less risk is where sleep comes into factor. And again, if we're just investing in domestic US equities, our efficient frontier has a limit. But if you put more diversified portfolios or expand your opportunity set to get more high return enhancements or higher return seeking projects or investments, and if they have low correlations, you reduce your risk. So the crux of the CFA exam is how do we build more efficient portfolios for more money and more sleep? And how you do that is you relax the long-only US, you expand to international stocks, you relax the long-only constraint, you can go long and short different stocks. You can add futures, options, alternatives, real estate. Again, the objective to have a much more diversified portfolio and a portfolio profile that goes up to the left. If you attend many continuing education events or hear many product pitches, this was, I do a lot of continuing education programs for the CFA San Francisco. In 2018, we had a wine hedge fund come through. And you know what they pitched us? Why you should be investing in a wine hedge fund? To lift your efficient frontier. If you have a small allocation of a wine hedge fund, you can increase your opportunity set for returns and increase your opportunities for low correlated assets to reduce risk. So then I offered the special bonus section for options. Again, derivatives are usually 2 of the 18 CFA study sessions. Usually people stick around. 1, because they're too pooped from hearing me talk about alternatives for 2.5 hours, and 2, because it behooves them to learn more detail. So I'll use this to outline what our next hour will look like, and it's going to be, kind of some option basics. Leon, I just as a side note, I teach risk management with derivatives for UC Berkeley. And I sent along my class slides for week 2, which does the basic P&L. So we'll be doing some basic P&L charting here. The definition of options delta, which is probability of finishing in the money, a hedge ratio, and the percent move for a option price over a move in the underlying price. We'll talk about implied volatility over realized. We'll talk about, much like alternatives, we talked about asymmetric or non-normal returns. And again, the crux of it, the Bon Jovi moment of the chorus, shot to the heart, you're to blame, you give love a. Who's going to type it in? Who knows that chorus? I blew this joke on Tuesday, but I'm sure I blew it in a memorable way. Bon Jovi croons, shot to the heart, you're to blame, you give love a. Oh, thank you, Raphael and Matthew Lee. Bad name. Bon Jovi fans, rock on. So again, that's the spirit. That's our chorus. Money, sleep, smoother and higher. And I'm going to ask. So again, I gave you guys a reading list. A reading list of 2. 1, please at least look at the Innocent Knupp Associates. I love all these white papers, but my 2 favorite are 1, the Innocent Knupp. It was the first one. And I think we sent along the link last time. It's 4 pages, so chances are if you took statistics, you probably got through it in 8 minutes. And my second favorite is by Wilshire Associates. It's the latest. So the first and the latest will give you a pretty good foundation. I asked people, anybody on the call a billionaire yet? I'm going to let you raise your hand if you are. And if not, don't give up. I believe in you kids. You guys can make it happen. But when you are a billionaire, chances are one day you'll have a family office and they'll do the investments for you. And more often than not, these big institutions of wealth will go to these big institutional consultants. And of the top 12 institutional consultants, over half of them have white papers on short volatility strategies or buy writing covered calls. That's why we're going to talk about these today. And the other 6 recommend it, they just don't have formal white papers. So again, why do we do this? I mentioned my second favorite was the Wilshire Associates. They do a white paper called 3 Decades of Option-Based Benchmark Indexes, or over 30 years of returns for these option strategies. And we are going to talk about the selling volatility strategy, not the buying volatility strategy. Again, we'll get to the crux of under the hood why these strategies work, but why this may appeal to you. The elevator pitch is buy and hold investing. It's pretty good. Buy and hedged investing, much higher and much smoother. So again, and I will say, if you are invested with, if you are a public employee or have a job, get a job for one of these places, as they all hire finance and accountants. It's not unimaginable that you'll work for one of these firms, but a lot of these pension funds of CalSTRS, PERS, Santa Barbara County, LA Police, Hawaiian Employee Retirement Systems, all are getting more and more into these short volatility strategies. And why do you think, Bon Jovi fans? Money in sleep. Money in the form of higher expected returns versus buy and hold, and more sleep in the fact that you're only bearing 2/3 of the volatility as opposed to the full brunt. And not only do you get more money in sleep, often when there's times of crisis, like the financial crisis, in that Wilshire white paper, they'll talk about drawdown length. And not only do you get more money in sleep over 30 years that options have been around, but a lot of times these strategies recover much quicker. And the whole reduction in volatility, we get back to even quicker. It's the Moneyball strategy. Less home runs, of course, but less strikeouts, but more on base percentages, more singles and doubles. We're generating more runs. We win more often. We win less, by lesser scores, but our winning percentage is off the charts, and that's what really generates the strategy. And why this is important to investors, in the introduction on Tuesday, Leon mentioned I'm a wealth manager. We are doing this on behalf of our clients because the average retail investor, for better or for worse, gets shaken out of a lot of the volatility. It's easy to invest in a market where everything's rising, but in a volatility world, I'm sure you'll hear some more stories about people who really puked out of positions this past March and April and were really despondent. And it's just human behavior. There's a fantastic consultant named Dalbar. Behavioral finance is also on the CFA curriculum. But Dalbar does behavioral finance consulting. And they say that over the long run, stocks have good returns, bonds have good returns, but the average investor doesn't realize nearly a fraction of that because, for better or for worse, they get excited when markets peak and they get despondent when markets are savage. Again, we're in the business not to oversimplify what we're trying to do. We're trying to buy low and sell high, but our fight or flight instincts make a lot of investors buy high and sell low, which is the opposite of what we want to do. So if you can bring this to your own portfolio, you don't want to be like most investors. This is for you young kids. I did this emoji graphs. You want to be stone cold and steady, smoother and higher. More money, more sleep. Less this, more of this. Consistency. And not that you can make investments return. We talked about non-normal distribution. The blue line is unhedged S&P U.S. large cap returns, a lot of fat tails, a lot of event risk in unhedged worlds. But you can engineer a path, and if you're going to Berkeley has a financial engineering program. You can engineer a more predictable range through the use of derivatives or options trading. And Charlie Ellis is one of Warren Buffett's kind of colleagues. He says it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. So again, don't swing for the fat tails of event risk. Again, just steady investing, sound investment principles, and we'll go through the underneath. But ultimately, again, Bon Jovi fans, why do we invest in alternatives? This is the buy and hold. Cucumbers, we want grapes. And I'll share a video with you on YouTube to explain what I mean. It's a equality study based on monkeys. I'll let you enjoy this for a couple of minutes. And I always thought bananas was the holy grail in monkey world, but it turns out it's grapes. Let me do this real quick. Monkey inequality. We'll take a little reprieve. Hopefully my volume is working correctly.
So a final experiment
Thumbs up if you can hear it.
Is our Fairman study. And so this became a very famous study, and there's now many more, because after we did this about 10 years ago, it became very well known. And we did that originally with capuchin monkeys, and I'm going to show you the first experiment that we did. It has now been done with dogs, birds, chimpanzees, but with Sarah Broffen, we started out with capuchin. So what we did is we put two capuchin monkeys side by side. Again, these animals, they live in a group. They know each other. We take them out of the group, put them in a test chamber. And there's a very simple task that they need to do. And if you give both of them cucumber for the task, the two monkeys side by side, they're perfectly willing to do this 25 times in a row. But cucumber, even though it's really only water in my opinion, but cucumber is perfectly fine for them. Now, if you give the partner grapes, the food preferences of my capuchin monkeys correspond exactly with the price in the supermarket. And so if you give them grapes, it's a far better food, then you create inequity between them. So that's the experiment we did. Recently, we videotaped it with new monkeys who had never done this task, thinking that maybe you would have a stronger reaction, and that turned out to be right. The one on the left is the monkey who gets cucumber. The one on the right is the one who gets grapes. The one who gets cucumber, note that the first piece of cucumber is perfectly fine. The first piece he eats. Then he sees the other one getting grape, and you will see what happens. So she gives a rock to us, that's the task. And we give her a piece of cucumber, and she eats it. The other one needs to give a rock to us. And that's what she does. And she gets a grape. And the other one sees that. He gives a rock to us now. Gets again cucumber. He tests the rock now against the wall. He needs to give it to us. And he gets cucumber again. So this is basically the Wall Street protest that you see here.
So as fun as that is, if we are trying to act in our best interests, a lot of advisors out there offer buy and hold strategies. What we're trying to offer is buy and hedge strategies. Why again? For more money, more sleep, or more grapes. That's kind of the crux of the why. Hopefully, if money and sleep appeal to everybody here, especially if you're on a finance or accounting major path. Hopefully, I made a case. This strategy may be interesting to us. And how does it work is probably the next question. Well, what we're doing, of course, is if we're holding a security, a stock, here's a P&L diagram or profit and loss diagram of a buy and hold investor. If it goes up, you profit. If it goes down, you lose. What we're doing with a covered call strategy, we're selling a call against it. In effect, we're taking in income today in exchange for our upside. So how this reduces risk or gives you more sleep is the fact that, sorry, I'm keeping up with the chat window on the side. My apologies for being a bit distracted, but let me clear that out. Can I? Oh, there we go. If you focus on this side of the
Then check the question, the Q&A, because I didn't know how to answer it. So if you can go in and look at answered questions and answer the question, because I have no idea what it is.
Somebody asked what were the 3 steps to take. I'm not familiar with the steps. But I'm outlining the process now, so maybe this will address that.
Thank you, Jonathan.
But ultimately, you're selling a covered call against that, and it reduces risk. Let's go back to your basic finance class. So remember, you're selling at the money option. The delta is 50, meaning there's a 50% chance it will finish in the money. There's a 50% chance it will finish out of the money. So let's kind of do the basic math of correlations. So if you're an underclassman, if you haven't taken statistics yet, you'll soon learn a lot about statistics and correlation. If you're an advanced class, let's see if you can type in the chat, which I may have lost. But let's focus on this half of the line. What happens if the security moves up and down? It has no effect on your security. The correlation is, let me see if I can find the chat window. Has anybody replied? I'm going to wait.
Not yet.
Price of 2 securities, one goes up or down, has no effect. What is the correlation of these two?
I know we got smart people out there. Come on.
I'm giving them a big hint if they're looking at my video. Kenneth, shout out to Kenneth. 0, right? There's a 0 correlation. Something goes up and down, has no effect. That happens half the time. What happens the other half of the time if something goes down and up and the other asset goes up and down? The correlation is, Kenneth, I'm banking on you to solve this. One would be down. I'm asking, what happens if the blue line goes up and the green line goes down, or vice versa, down and up? For this half of the equation, the correlation is -1. Jacob, Jacob, when you type in an answer, also type in your university. I'll give you a shout out because they're teaching you good stuff. Raphael and Jacob. Time is -1, and if we take those probabilities, given that it's half and half, we're effectively selling a -0.5 correlated asset, right? Half the time at 0, half the time at -1, it works out to -0.5. A delta of a short call is -0.5, which when we combine these two securities, we effectively have a synthetic put, which ultimately looks like we keep income for the tenure of the options, and we assume somebody's downside risk. Anybody think of a business that operates on assuming other people's downside risk? I'll let you type it in there. Usually if I'm in a class of, the CFA is kind of a graduate program, so a lot of people have jobs, and when they have jobs, a little portion of their paycheck comes out to cover an expense. Can anybody name that expense? I'm looking at the chat window in detail now. Somebody mentioned as well, but Michael Campbell, you probably have a paycheck. You probably pay for this. Jacob Nanama. Type in your university in there, Jacob. Well done. Insurance. So, you pay a fixed rate, and an insurance company will give you life insurance, health insurance, car insurance. And this is where I usually ask people, and you can do a show of hands if I'm clever enough to do the hand clapping. Who here owns insurance? Hopefully all the hands are going up, or you have some insurance of some kind. Maybe your parents and the school offers it. And then I ask, who here has ever profited from insurance? And all the hands go down. Oh, Health Business School. Props, Jacob. They're doing a good job for you guys. So again, in this class of room of 50 professionals, everybody owns insurance. Who here has ever profited from insurance? All the hands go down. Usually one or two wise guys keeps their hand up, and I say, listen, wise guy, just because you pay AAA, $30 a month to tow you when you have roadside assistance, if you paid $3,000 worth of premiums through the years, they tow you for $800, that's not a profit. So hopefully all the hands go down. However, sometimes one hand stays up. I usually say, I have a few guarantees. I can near guarantee something terrible will happen to that person if we do a traditional distribution of returns. And the reason so again, we know why it reduces risk, right? We sell a -0.5 correlated asset. But the other important thing is, we can live in a non-risk taking world and not have any rewards. We want to take risks that are well compensated. And the reason that this works on the return side is we're selling implied volatility greater than realized, meaning people will overpay for insurance. So if you want to stretch that analogy, again, you know what every skyline in this great world has in common? The Trans-America building here in San Francisco, in my beloved hometown of Boston, the Prudential and Hancock are two of the tallest buildings. They're also amongst the two tallest buildings in Chicago. You walk across Manhattan, you're probably across a dozen of these type of firms, all insurance sellers. You never see in any skyline? An insurance buyer building. Let's sell insurance. Let's get out of the mindset of buying insurance. Let's, assume some risk for overpriced, traditionally there's an overpriced security. And what do we want to do? We want to both buy low and sell high. And there's a consistently higher price security. Let's exploit it. And that implied volatility over realized, that big or that edge, doesn't just build skyline. It builds cities. Because that, the implied over realized builds a ton of buildings in Chicago where the Chicago Board of Options Exchange is. Implied over realized insurance builds tons of stuff. But the implied over realized, like the 49% win rate on blackjack, doesn't just build skylines, it builds cities. Macau, Atlantic City, Vegas, it's all built on that bigger edge. So how do we get that bigger edge in our portfolio? And what we want to do is, here's kind of the mathematical back testing. We can really go far down the rabbit hole. But what these graphs say, over the long run, implied volatility will be greater than realized, and that will be your compensation or the volatility risk premium that you sell. So we're in the mindset of not playing blackjack, let's deal blackjack. In our portfolios, let's not buy insurance, let's sell insurance. In these asset class, again, in terms of Moneyball, smoother and higher, I'll make a case to be your threefold risk manager in the next 30, 40 minutes. I want to be your financial risk manager and teach you to sell volatility. I want to be your personal risk manager, and also, time permitting, I want to be your spiritual risk manager. So we're very ambitious next half hour. But the purpose of this, what we're trying to do, this is, again, if you put a traditional put writing index on top of your traditional bond and stock portfolio, we lift that efficient frontier up for more grapes, more bananas in the monkey world. And I had the good fortune of consulting Wisdom Tree when they launched their put right. We were kind of outlining what their next product set built around options would look like. And they were kind enough to pay for options data, which needs to be scrubbed and not cleansed easy or cheap. They paid for it, and we did these basic coverage call strategies that were outlined in that 4-pager by Ibbotson. And again, dozens more since. If you believe selling a negative correlated asset versus your long should reduce your risk, and if you believe in the second foundation that implied volatility should be greater than realized, that there should be an insurance risk premium out there or a volatility risk premium to harvest, you can do this across asset classes. The blue line is buy and hedge versus red being buy and hold. Emerging markets, smoother and higher. If you invest in gold, you're investing in the dumb rock that doesn't know what money is. You write options on that dumb rock, it yields you about 1.5%, 2% a month, smoother and higher. And across asset classes, I think you'll eventually learn what the Sharpe ratio is. It's the unit of return you take for a unit of risk. Across equities, U.S. large cap, small cap, international developed, higher Sharpe ratio for the buy right product. For bonds, you think people need to insure their bond exposure nowadays? Good grief, yes. Long bond, short bond, high yield bonds, much more risk compensating when you sell that covered call. Again, gold writing, real estate, oil, time permitting, we can go into some specifics, but again, a much more risk compensating return. I did that project in this, it ended in the spring of 2017. And they were readying to launch a bunch of these, that there was some market happenings at Wisdom Tree that caused that launch, but you can trade this with PUTW if you're looking to invest this out there. And I always thought this was a clever way. There's always these stock market gains. Investing that, again, not because you think everything is so great in the world, but because you should outperform. And that's not, I mean, usually you should either go high risk to, if you're in a contest and there's no financial impact, go high risk and try to be the best. But if you want to have a more mathematical favorite one, this thing performs the average buy and hold investment 2/3 of the time because of that income you take in. And you can apply this across asset classes. I mentioned hedge funds are a big proponent of alternative investing. And one of the bigger hedge funds is a group called AQR, and they penned a article for the KAYA designation. So the CFA is the Chartered Financial Analyst program. The KAYA is the Chartered Alternative Investment Analyst program. They focus strictly on alternatives. So if any of this appeals to you, maybe you investigate getting your KAYA designation. But they write, was the CFA writes the Journal of Financial Analysis. The KAYA does the Journal of Alternative Investing, and this AQR outfit headed by Cliff Asmus. If you listen to podcasts, he's one of the more colorful guys in the business, but his research team did the same study that I did for Wisdom Tree just 6 months later and had it published in the Alternative Investment Journal. And they say that no matter what the asset, let me reduce the size here just a bit, you should be compensated for taking on downside risk. They extend this to other asset classes, much like we had shown above. And there's a volatility risk premium that's consistent against all these assets. Again, people will pay you to insure their U.S. large cap stocks. They will pay you to insure their international. They will pay you to hedge their interest rate exposures. I mean, you don't think banks in more this day and age, people will pay you some kind of insurance for that. Jewelry makers will pay you money to hedge their gold exposure. Down the street in San Ramon, California, Chevron has a big presence, and they also have a big trading floor. You know what they do? They hedge a lot of bets with energy, oil, alternative energy, and the like. But again, people will pay you to insure their investments, and the conclusion of this paper is, instead of just kind of buy and hold, buy and hope, let's buy and hedge. Let's seek to be on the other side of those selling insurance. Again, in terms of exploiting fear and greed, Warren Buffett famously croons, "Be fearful of those who are greedy, be greedy where others are fearful." But Warren Buffett doesn't tell you how to measure it. In the options world, there's something called volatility indexes, or AKA fear indexes. And this is kind of funny because this was taking this winter. We were in a very complacent world. There was like no fear pre-coronavirus on February 25th. We'll take a look at how the world has changed since. And how you read these volatility measures, if you ever want to have a party trick and impress somebody, there's something called the rule of 10. Let me just pull up an updated version to show you what I'm talking about here. So for those interested, I do an options meetup group, and we go over this pretty diligently. But I'll post in the chat notes as well. Meetup. I used to meet at Buffalo Wild Wings in San Ramon. I know there's a lot of East Bay colleges out there, and if we ever go back there, please join me at Buffalo Wild Wings in San Ramon. Because again, we talk about money, sleep, and we drink beer and eat spicy wings, which is usually a good time. But please check this out. I posted it here, but we looked at this volatility monitor. So the purpose of the options meetup is to, 1, increase the education knowledge, 2, help Jonathan Masse build the brand to be known as the options wealth manager, and 3, hopefully learn a bit of something. And we study this volatility across the globe, and whereas in February the VIX fear index was 12, and just to kind of give you a normalization of that, over the long run the VIX is 20. Sometimes we get too complacent and we'll slip down to single digits, and then every 2 or 3 years there's some event that gets us above 30. And this past March, we got to 80. So again, real extreme events. We officially tapped out at 82. Currently, this is as of, let me go to the updated tab. My apologies if this is wrong. Today, sorry, my computer's low, so I have a lot of stuff. So again, volatility peaked in March. It's getting much more to a complacent level. Probably no small part because if you took a 7-month siesta, you went to bed, S&P was 3,500. You woke up, it was 3,300. You probably think, oh God, wow, not much happened this year. But holy cow, what a difference a year makes. But now that volatility tends to be negative correlated with stock market performance, so when the stocks dropped, volatility exploded. It got to 82. It was historic. And now that we're kind of at all-time highs, volatility is really sold off. And my party trick is, so again, we're trying to find volatility across the globe. We're looking at it across the Americas, Europe, Asia, broad markets, interest rate markets, commodity markets, currencies, single stocks as volatility indexes on. What's interesting is the general volatility of the S&P 500 right now is 22, whereas the stocks that have really driven a lot of performance, there's a lot more fear in these things. probably in no small part because these big behemoth companies have been the real headline risk bearers as of late. That's how we kind of look at volatility across the globe. So what these numbers mean to you is, probably not surprising. We're trying to look for fear here. We're looking at high volatility numbers for the last trade, and lo and behold, this may not come to a surprise, but Brazil, who's very dependent on oil VIX, 40-ish, very high volatility. Brazil has a lot of energy names, but in the world political space, if there's a market that's handled the coronavirus worse than us here in the US, it is Brazil. The volatility, not surprisingly, twice that of the US. A lot more sector-specific risk, a lot more health risk, a lot more risk in emerging markets. But what this means to you is, what is the compensation I get for writing an insurance contract? So there's a clever math trick with the VIX that I mentioned, a party favor. If you divide the VIX by 10, you can estimate a 1 month at the money auction premium. So let's take a look at EWZ. There's a Bloomberg screen. Admittedly, my machine is very slow. EWZ, equity, on. We're going to seek out a 30-day volatility. And remember, the VIX for Brazil is 42. So what is our estimated 1 month premium going to be? Anybody divide 42 by 10 for me? Feel free to put it in the chat window. The estimated 1 month premium will be, I'm betting on Jacob who can divide it for me. We're going to estimate the premium of, we'll try to find the 4.2. Jacob, I knew I could depend on you. So this won't be perfect because VIXs are based on a 30-day number, and right now we have a 15-day or a 43-day number. So we'll estimate the best we can. But the at the moneyness of 32. Let's take a look real quick. Get my fancy CFA approved Texas Instrument calculator. We're going to divide the at the money call. We'll say 1.72. 1.72 divided by, and mind you, it's not going to be perfect because it's a little bit longer than 30 days, so we're expected to be a little bit higher than 4.2. When we divide it by 32.04, we get an estimate call. We'll say 1.72. 1.72 divided by, and mind you, it's not going to be perfect because it's a little bit longer than 30 days, so we're expected to be a little bit higher than 4.2. When we divide it by 32.04, we get an estimate of 5%. So again, not perfect. What we need to do is find a 30-day contract. Let's see. Let's go to, what I'm trying to get on here is weekly contracts, because we'll be able to put that. Anyway, in 13 more days, please do this exercise again. I will near guarantee you will be 4.2%. But again, because it was longer, and what we can do, let's go back to WZ. So a month-and-a-half option was just over 5%. Let's take a look at a 15-day option. We divide 1.06 divided by 32. We get 3.3%. I think the 45-day option was 5.3%. So if we split the difference, our estimate would have been 4.3, whereas our rule of thumb got us 4.3. So Jacob, another shout out to Hulk program. You can divide by 10. Bravo, bravo. But again, in terms of where we've seen volatility as of late, in silver, I don't know if anybody follows the metals market, but there is a big fear of missing out. The way governments are printing money, SLV, equity, DOLL. This is really a remarkable chart in terms of, we're talking about fear and greed. I follow a moving average convergence divergence technical, and this is just incredible. I'm going to go back 5 years. So here's a chart of silver for 5 years. It's been pretty consistently in the range of 14 and 18. This thing, again, usually this moving average convergence divergence hovers between +1, -1. It is, silver is just absolutely skyrocketing. The fear isn't to the downside. The fear is on missing out on how quickly this is. And if we go to our handy dandy world volatility monitor, lo and behold, silver vol, 7.6%. And we're going to quantify what 76 vol looks like. Mind you, our vol during our coronavirus got to 82. So right now, silver volatility is almost virus-like, if you will. There's such a fever in of this thing. And again, in terms of sketching out a at-the-money option, we're going to guess it's going to be about 8% a month. That's not to, so if you take on the downside, that's not to say silver won't go up or down 15%. If you keep harvesting that 8% a month, more often than not, smoother and higher. So again, we'll do the average of the two strikes at the money, around 27-ish. We'll take 2.57 plus 1.62 divided by 2, decimate the 30-day. So the average 30-day premium will be $2.10 divided by 26.88, a premium of 7.79. So that rule of thumb trick, if you are at a party where this impresses people, I want to be invited to that party. I think we can impress a lot of people with rule of thumb. But again, to our trading, our portfolio management, how do we measure fear and greed? Let's go to these fear index. So again, I promised, I had an ambitious tablet. I want to make a case to be your financial risk manager. Have you got the mindset of buying options? Let's sell options. Options are overpriced. You want to sell overpriced assets. However, as your personal risk manager, this is where I usually say, who wants to sell insurance? And everybody's like, yes, this makes mathematical sense. Oh, this is great. However, who wants to cancel our insurance? People are like, yeah, it's the worst investment I ever make. I never profit from insurance. As your personal risk manager, please don't cancel your insurance. There is value to insurance. Let's not fall for the trader's curse. The trader's curse is knowing the price of everything, but the value of nothing. And I'm telling you, when just to let you know how to quantify fear and greed, what this looks like. Again, here's emerging market volatility. The implied volatility of this was taken in a much more complacent environment. The implied VIX there was 15. The historic was 11. Again, these things still trade consistently overpriced to give you that volatility risk premium or that insurance premium. And if you want to know what volatility of 70, 80, what silver is going through now, what we went through this past March or near it was, during our financial crisis, our VIX popped up at 80, and they're describing it as the nuclear meltdown of our financial system. I'm a rare bird, and I'm kind of a volatility historian. And the Nikkei VIX got to 70 in March 2011. Anybody remember what happened to Japan in March 2011? In the interest of time, I'll kind of lead you to this, but there was the tsunami nuclear scare. So let's say that 70-80 ball is nuclear. We showed on the volatility monitor that virus fear is even worse than nuclear fear, because it top ticked at 82. But 70-80 ball is nuclear. And, as your financial risk manager, let's sell options, sell insurance. It's very profitable. As your personal risk manager, please don't cancel your insurance. And I say that from a place of, real hope. Again, there are going to be things that happen to you in this life that, you're going to want to have insurance for. It's going to be some sleepy Tuesday. You're going to get a high PSA test. It's going to lead to high aggressive prostate cancer. You're going to have surgery, radiation, hormone therapy. These aren't hypotheticals. This was my 2017 to 2019. So again, please don't cancel your insurance. But in your portfolio, let's sell insurance. And the reason we do it again is because we're going to get from point A to B. Buy and hold gets you there like this. let's buy and hedge, get you there smoother and higher, because life is going to throw volatility at you, whether you like it or not. And so let's control volatility where we can. We control volatility in our investment portfolios. Just not a lot of people take that care. And I'll share some kind of, again, my ambitious plan was to, one, make a case to be your financial risk manager. Let's sell options. Second was to be your personal risk manager. Please don't cancel your insurance. As your spiritual risk manager, this is not preachy. This is game theory. Think about Pascal's wager. Pascal is the famous mathematician and philosopher. He says in Pascal's famed wager, there is no downside to believing in a higher power. And I'm not going to get preachy, but I can tell you, I believe this world's been very blessed. We've had a lot of great blessings in this world. I believe in JC, Moses, Buddha, Confucius, Muhammad. I think they've all walked this earth. I'm not telling you which one to believe in. I'm just telling you to believe in a higher power. And think about this. Think about the game theory about believing in a higher power. The two-case scenario. One, believe in a higher power, live a good life, and there is no higher power. You still live a good life. It's not that outcome. But think about the flip side. Believe in a higher power, live a good life, and there is a higher power. The kingdom of heaven awaits. Your ultimate free call option. So again, believe in a higher. That's the only option I'll ever tell you to buy. There's also, if you're ever despondent, again, we're in fear and greed, but if you ever want a prayer of hope, if you're really despondent, I know my daughter's going to be a freshman this year, and she's very despondent. St. Jude has a great prayer of hope, and it's probably not the most inspiring diplomat, but there's the famous Machiavelli and the Prince, and he has this fantastic quote about taking risks. He says, all courses of action are risky, but prudence is in avoiding danger. It's impossible to avoid that danger, but in calculating risk and acting decisively. Let's make mistakes of ambition and not mistakes of sloth. Develop the strength to do bold things. So again, I really applaud you guys for doing something out of your comfort zone, joining this 5-week program. Leon, very ambitious putting this together. I really think you're adding value to your network, and again, a real kudos. Any questions on financial management, risk management, personal risk management, or spiritual risk management? Otherwise, I can fill the remaining 12 minutes with some option case studies. But any questions on covered calls or selling volatility strategies you'd like me to address? I'm happy to go through case study.
Hi, Jonathan. It's 3:33. Do you want some additional time, or do you think this is enough? What do you think?
I was thinking I was due to end at 3:30, and then there was Q&A till 3:45. But if 3:30 was, if I mistook 3:30 is my limit, I'm happy to sign off. Oh, but if you do want to do these case studies, again, I would suggest coming to that options meetup. I will say, if I can offer you some career advice, this is my last class, is one thing that they taught us in my first day of my MBA class, and I forgot a lot of things after the first day of my MBA class, is they said, if you want a successful career, you need 2 things. And of course, everybody in MBA wants to have a successful career, so everybody leans in. What are the 2 things? They said, 1, you need ambition. And if you're doing this in addition to your internships or in addition to your basic studies, I like your chances of proven ambition. Your second thing to keep a good career is maintain a good network. So I do appreciate those who reached out, but again, please don't reach out to me blindly. It's a pet peeve of mine. I think I teased a few kids on this, because you will get the default. And I think even Michael Campbell got this from me when he reached out blindly, but I think we're better for it because we're good friends now. I say, thanks for the lookup. It's been a lot of years, a lot of miles, a lot of faces. Might you help refresh me into our acquaintance? It seems like we run the same circle, same interests. I just need specifics before I accept you. Because my hope is,
Jonathan, I thought you just said that to me.
No. I send it to people. I think that we've had a unique relationship since, and we're better for it. But again, it's a bit of a snotty email, but please know.
Actually, you're right, Jonathan. I said you're right, because we definitely hit it off really well.
Agreed. So my advice to you kids is plugging me some very influential people you want to keep in touch with. Please give them the courtesy of, setting the table. There's a guy who was on Tuesday's call. I used him as an example. He was just a cute little introduction saying, hey, not hey, add me to the network, but he set the capture. He's from Santa Clara. He heard the street smarts, and hopefully we'll keep in touch via LinkedIn. I'll monitor his career. And the hope is, in terms of your network wheel, things like this. But you can put a little emphasis in it. Some of the synergies, collaborations that come up really can, take off. Because I have a feeling one day it's going to say, somebody's going to say, hey, Jonathan, I see you're connected to Mika. How do you know him? I can go back here and go, oh, I know him from the Street Smart. Then I'll go to Mika's profile. And again, Mika, if you're on this call,
there he is.
I know you're a good sport. One day he's going to graduate from accounting major. He'll probably be in CEO of Deloitte one day. Who knows? Maybe he'll want a financial risk manager, enter Jonathan Masse, or maybe one of the studies. You'll be running off the strategy.
Hey, Jonathan, you have 3 questions in the Q&A.
All right.
And I know Micah now too, by the way.
Oh yeah. Again, good kid. He was kind enough to write a little introduction. All right. Oh, and this is funny. Somebody's asking about a book. This is a very advanced book. Option Pricing Volatility by Natenberg. If you were on the floor and they give you a trainee position and they don't give you this book, you're just a clerk. They're not going to get you to trade. Read this book if you really want to have a deep understanding of position management. This is very advanced, though. Until then, a lot of undergraduate classes, I know this because Berkeley, I'm trying to teach this August, and I'm using this book. Don Chance writes a lot of the CFA material. So you're going to hand on any CFA material, guys, that's probably not a bad place to start. Level 1, that is. Then you can get more advanced and use level 2, level 3. But we use this textbook in my class, An Introduction to Derivatives and Risk Management by Don Chance. I often say that if Natenberg, the green book I had on my shelf, is the New Testament, Larry McMillan writes the Old Testament. He writes very detailed strategies. So in our class today, we just kind of went through covered calls or synthetic cash secured put writing. There's a lot of ways to trade options. And again, I do think the more mathematical favorable is to be short options. And I will type, I will pull these up. Mika, you're one handsome gent. Let me go to Amazon.com. Oh, actually, here's my textbook. And I'll put this in my the chat. That's the textbook. The Old Testament was Larry McMillan. Oh, and there's a great show on CNBC every Friday at 2:30. CNBC has a half-hour show called Options Action. It's really, really spot on and entertaining, whereas most things are not entertaining. Here's the OT Old Testament. I'm putting in the chat window, Larry McMillan. And the New Testament is Sheldon Natenberg, Option Pricing Volatility. You mentioned Pensera is a sponsor. They have a big presence in Chicago. And I am near certain, I don't know if anybody from Pensera is on this call, but if you ask anybody at Pensera what the best option pricing book is, I would be surprised if it is not Sheldon Natenberg. And if they don't name Sheldon Natenberg, you can ask them if they read it. I can near guarantee you, if they're in the options division of Pensera, they probably have this green book on the shelf.
Hey, Jonathan, Allison is on from, she's new to Pensera, but she was in charge of the Pensera virtual internship day.
Oh, that was very well done, Allison.
It was done. It was excellent.
Bravo to you. That was I sent some students that way. Oh, and Miguel is saying he interned at Pensera.
Yes, he did.
Were you
I
at the
know Miguel too.
Were you in? If you were in the options department, you should know this book well. But if you weren't, chances are you probably helped out one of the bond or equity guys. I would speculate. But if you want to hit them up for an option job in Chicago, read this book. And, the world is yours. You're welcome for the shout out. Well done. So again, just to recap, if you're doing a lot of these, if alternatives or options are appealing to you, more likely than not, they're going to become at the end of your undergraduate career in the form of like an advanced elective. But there's tons of ways to learn this stuff on your own. I think it just caught your eye. Again, if you want to manage money, the CFA, if you want to manage alternatives, that Kaya designation is pretty well. But again, to have success, show some initiative and network. That's my advice. And sell volatility in the portfolio for a smoother, higher run. Because again, a lot of ways to go from point A to B. So much volatility in the world. The FDA wouldn't say we're running cancer-free portfolios, but everybody in my cancer support group says they know exactly where they got their cancer. 2008, 2009. I have a feeling cancer is going to have another resurgence after this past summer. So let's control risk where we can. Let's invest in some of the most risk thoughtful strategies, put edge in pricing on our side, and let's see where the chips fall from there. Because you can put yourself in the best position to win. So that's what risk management is all about. Risk management isn't about the avoidance of risk. It's about market value and taking calculated risk. So thank you for the audience. Michael, it's always fun. You get me in the audience, but I like to think I had some value to this crowd. And again, Leon, I remember us talking about doing a 10-week program. And you whipped it into 5 weeks. So again, a big kudos to you. And Leon, do I give you multiple choice questions next? And we can talk.
I think so. Leon he's up in Tahoe and his internet keeps going out. So he's not on right now. But what I was going to say was, I guess maybe after this virus is over, that we can do another trading game.
Oh, that would be fun.
That will be fun. Only for the smart people. I just watch because I'm not one of those people, but it's amazing. I've seen it twice.
Yeah. If I can plug it in advance, I'll put the curriculum in the chat window.
Okay.
It is a lot of fun. Somebody was kind enough to say, when I was in iShares when we first launched out in the capital markets, they said, I learned more in 1 hour of the capital markets trading game than Jonathan Masse.
Oh, yes, sir, you do.
2 years at Prudential Securities becoming an advisor. But to be fair, if they
still don't know how you do it, Jonathan, keeping all those figures in your head.
To be fair, if you have an advisor job, they want you to sell. They don't want you to know anything about capital markets. Sorry.
Well, I think I guess I have to stop this since it doesn't look like Leon is back on. So, Jonathan, again, thank you very much. Thank you for everyone that has participated so far. I do want to give a special shout out to Allison again. I think starting on Tuesday, she has about 34 or 5 folks that were at the virtual internship that will be joining us next week. So just really excited to be working with Pensera. They're great people, great people.
I just found the curriculum.
What do you want to do? You want to put it in the chat or?
Yeah, or ultimately when the trading game does come along, it's a big hoop. We take a look at the specialist business model, effective volatility on derivatives, basic supply and demand, and what it means to market, according to two-sided paper flow, trading for edge, price discovery, game theory, and basic stats. It'll be a lot of fun.
All right. Bye, everybody.
Very good.
Thanks, Jonathan. What?
If you are on LinkedIn and reached out, it'll be good to follow your career. But again, if you can hit likes on some of the stuff I put out there, it helps generate goodwill. And that's his little tip on your own career. You know, help that network. You know how you get visible to the network? Like, support, share, and a lot of this stuff goes a long way. All right, be well.
Peace.